Hi, I'm Patu from freefincal. I thought I'll do a basic video on what is market timing, how is it different from a SIP, or whether you can do both market timing, or when if one can do both market timing and SIP. I find that even experienced investors make mistakes and have wrong perceptions about what these are and how they differ or they don't differ. So, what is an SIP? An SIP essentially is an automated method to buy mutual fund units on the same day of each month, typically each month. That is all. There is nothing more, nothing less to an SIP. It is just an automated method of purchasing mutual fund units. Now, market timing refers to the change of amount of equity or amount of fixed income or amount of gold that you have in your portfolio depending on market conditions. That is, let us say, suppose you are holding 60% or 70% of equity. They can be stocks and or equity mutual funds. And if you think the market has become too overheated based on some metrics, we will talk about that. You book some profit, you sell some equity allocation, reduce, let's say, from 70% or 60% down to 40% or 30% equity, and you shift it to safe assets like fixed income. Then when you feel that the market has cooled down or fallen down significantly, then you sell the fixed income and buy, get the money and buy stocks or buy equity mutual funds and increase the equity exposure, and then do it again and again as per the market conditions. You can choose the metric that you want. That is called market timing. Now, what many people think is that it is not possible to time the market. This is what all these mutual fund distributors and the AMCs will tell you, because all they want is for you to lock your money in SIPs. They will not tell you the truth. The truth is the market can be timed. It's just that you should be clear about your goals. If your goal is to reduce the risk in your portfolio systematically, then the market can be timed without any question. There's no problem at all. Back tests will tell you that is definitely possible. But if your goal is to try and beat the market, that is, get more returns than the market, then back tests will tell you it's pretty much a coin toss. Sometimes, depending on the sequence of returns, if they are favorable, sometimes market timing will get better returns. Sometimes, if the sequence of returns are not favorable, market timing will perform very poorly compared to a standard SIP and so on. I have done multiple posts on this, even videos on this. You can check this out. I have an archive called Market Timing Archive at freefincal. Is a separate category. You can have a look at this. I also have a market valuation tool which you can use, and so on. So what are the different types of timing the market? You can use multiple metrics. You can use Nifty P, Nifty PB. For example, the Motilal Oswal, the MOVI index uses near P plus PB plus dividend yield. You can use double moving averages. You can use 10-month moving averages. You can use Bollinger Bands. There are multiple methods available. Each of them work or don't work in a different extent, that you have to look at the individual back tests to study. But in principle, it's very possible to reduce market risk systematically by using these timing methods in your portfolio. And for in fact, one of the best examples of that is the Franklin India Dynamic PE Fund of Funds. Now it uses PE plus PB combination. That is, it has got close to Nifty returns, or a little bit less than Nifty returns, at almost 50% lower risk. So, as a simple example, suppose the market has given you 12% return, and over this period you have got only 10% return. You may think you have not bet the market, but if you have got the 10% return at 50% lower risk, then I think you have bet the market. I mean, that's a phenomenal achievement to get close to market returns at significantly lower risk is a phenomenal achievement, and that's what this fund has done. So it's definitely possible. Of course, the question people will say, oh, emotions will be there, investors will be subject to behavioral bias, blah blah blah. That is always there. Everybody has behavioral biases. Advisors also have their own biases. That is a different matter. As a technical question, whether can the market be timed? Yes. Behaviorally, emotionally, even crossing the road is a behavioral problem. Many people cross the road in a very risky manner. That you cannot control. Technically, can it be done or not? Yes, it can be done. And it can be done with a lot more frequency than climbing Mount Everest. That much I can tell you. Now, many people make have the wrong assumption that they can have a SIP running and they will buy on dips whenever the market falls by 10%, whenever the market falls by 20%, whatever in their whatever they perceive it as a fall, they want to buy extra. They think that buying on such dips is market timing. Well, you can call it whatever you want, but if you actually do a back test, and I have done this and I have also made a video on this, you will notice that it neither reduces risk nor does it enhance return. So it is actually not of buying on dips is practically useless. It is just psychological comfort for those who are scared of paying taxes when you rebalance or when you book profit in equity and shift it to debt and shift it back from debt to equity. You have to pay tax. Most investors today are more scared of taxes than getting returns or managing risk. They will say, if I don't have to pay tax, I will settle for a lower return. That's the kind of mentality. That's I don't know that I can't I don't know how to even start commenting about that. So don't waste your time trying to buy on dips. You can do it as some psychological benefit and for putting more money into the portfolio, but don't call it market timing, or at the very least acknowledge that it doesn't do anything. All right, now the question is that if I do market timing, um, should I avoid SIPs or can I do both SIPs and market timing? The point is that whenever I have always been telling people, stop doing SIPs, do automate or don't do automated investing, do manual investing. That's the real way to inculcate discipline, and you get into portfolio management hands on much better that way. Then people will say, when should I buy it? Well, are you advocating market timing and so on? The problem is, this is the big problem I want to address here. Systematically buying or investing every month is completely independent. Timing the market where you are changing the asset allocation in your portfolio is independent. These two can coexist peacefully. I can systematically invest each month either via SIP or manually and time the market if I want to. So there is no problem. There is no need for us to avoid SIPs, even automated ways of investing, if I want to time the market. SIP should reduce risk. Is that not enough? Is a question that other people ask. No, SIPs do not reduce risk. Please check out my video on this. See my posts on that. It is just all these sales guys doing propaganda. The SIPs just can never reduce risk by definition. Do I need to time the market? Is a much more intelligent and relevant question. You can time the market, but do I need to do it? Just because something can be done, do I need to do it? The answer is no. You don't need to time the market. If you practice efficient portfolio asset allocation and have a plan how to reduce this asset allocation with time, then there is no need for you to worry about timing the market. In fact, this is what we talk about in our lectures on goal-based portfolio management in our Facebook group. This is what we do. So please don't get wrong ideas saying that SIP is different, market timing is different, market timing will not work, and so on. Those are all wrong conceptions. You can have an SIP running, even an automated SIP running, and you can peacefully time the market along with it. There's no problem. Please don't listen to mutual fund distributors and AMC buggers. All they want is AUM. They don't want you to book profit from mutual funds. They just want you to say, I will do an SIP for 1 lakh every month until I die, and they will happily take it. So that's all they care about. They don't tell you the facts, and these are the facts. You can time the market to reduce risk. There is no question about it. Returns is a coin toss. You don't know what's going to happen, and you can keep an SIP running, either automated or manually, when you are doing it. What matters is whether that action is actually going to make a difference in your portfolio and whether you can measure that difference. Most people say, I did this, I did that, but how is it helping your portfolio? Have you studied the risk of all this or the benefit of all this to your portfolio? That if you're able to answer, then all other questions on strategies will become clear. So that's what I wanted to say in this video. Thank you as always for listening. If you have any questions, comments or suggestions, please leave them below.